They say it's never too late to start, a phrase that wraps you in a warm blanket of hope. But when it comes to building wealth, that comforting sentiment collides head-on with the cold, hard math of compounding. If you begin at 50, mirroring the strategy of someone who started at 25, the numbers don't just shift, they stage a brutal rebellion. It's not about how fiercely you believe in the power of compounding. It's about how long the process has to work its magic on your behalf. Yet, the world keeps chanting the same worn-out mantra. Be patient, and your wealth will grow. The truth? Patience is only potent when time is your ally. When time is scarce, you need a sharper, more dynamic weapon in your arsenal. Let me introduce you to Martin, a 57-year-old who's spent decades juggling life's demands, raising 3 kids, paying down a mortgage, and keeping the electricity humming. For most of his life, compound interest sounded like a buzzword for Wall Street tycoons in tailored suits, not for someone like him. Then, at 55, an unexpected inheritance from his mother dropped $30,000 into his lap, his first taste of real capital. Eager to make it count, Martin opened his laptop, typed, "Best way to invest late in life," and hit a digital brick wall. The internet was a cacophony of advice shouting start early or just wait it out. But what do you do when waiting isn't an option? What if you only have a decade, maybe 15 years, to make your money sprint instead of stroll? Martin didn't need feel-good platitudes. He needed a battle plan, a framework built for someone starting late but determined to finish strong. This guide is for the Martins of the world. It's not about telling you it's too late. It's the opposite. It's about rewriting the rules of compounding for those who don't have decades to spare. You can't rely on the slow, graceful arc of exponential growth. Instead, you need rapid cycles, bold moves, and a mindset that thrives on agility. If you're new to this journey or missed the earlier parts of our Compounding Comeback series, I recommend circling back to parts 1, 2, and 3 after this. They lay the foundation for what we're diving into today. Links are provided below. If you're ready to transform your financial future, subscribe and let's get to work. Facing the time crunch head-on. Let's start by confronting the elephant in the room, time compression. Compounding isn't just about the rate of return. It's about how many times that return gets to double down on itself. The harsh reality? If you're starting at 55, you've missed the steepest part of the curve, the back end, where wealth snowballs into something transformative. This isn't pessimism. It's the unforgiving math of exponentials. You can't rewind the clock, but you can reshape the path ahead. The secret lies not in mimicking the leisurely pace of a 25-year-old investor, but in stacking aggressive, strategic moves that amplify every dollar you deploy. Think of wealth building like planting a tree. If you sow an apple seed at 25, by 60, you're harvesting bushels from a mature orchard. But plant that seed at 55, and you can't afford to wait for nature to take its course. You need to transplant a young tree, enrich the soil with fertilizer, water it relentlessly, and maybe even build a greenhouse to force growth. In financial terms, this translates to higher contributions, savvier asset allocation, and calculated risks you might not have considered in your youth. Your goal shifts from let it grow to make it soar. And here's the game changer most late starters overlook. Your greatest asset isn't time, it's focus. You may not have 40 years, but you have clarity forged by experience. With the right framework, you can compress decades of growth into a handful of years. The trap of doubling down on savings. When people realize they're late to the wealth-building party, their first instinct is often to save harder. They slash expenses, skip vacations, and pour every spare dollar into a savings account or index fund. It feels noble, like a sacrifice for a greater cause. But here's the trap. Saving more isn't the same as growing more. Without a structure that accelerates your returns, you're just piling up cash in a low-yield parking lot. It's responsible, sure, but it won't rewrite your financial story. Compounding isn't about how much you pour in. It's about how fast your money multiplies. Dumping an extra $500 a month into a generic fund with lackluster returns doesn't move the needle. It just exhausts you. Late starters often feel stuck because they're playing defense with a strategy that demands offense. This doesn't mean you need to become a reckless day trader or chase the latest crypto fad. It means shifting from save more to build smarter. Select assets with precision, reinvest with purpose, and use cash flow to acquire income-generating investments. not just pad your bank balance. It might even mean rethinking debt, using leverage strategically to buy time you don't have. Wealthy late starters don't just tighten their belts. They rewrite the playbook, prioritizing velocity over sacrifice. A new playbook for late starters. So, what does a smarter compounding strategy look like when time is short? It's not about working harder or saving more. It's about making your money behave differently. The wealthy, whether starting late or rebuilding from zero, don't follow the 25-year-old slow and steady plan. They stack compounding levers: cash flow, asset growth, strategic reinvestment, and selective leverage to create velocity. Let's break it down with an example. Imagine a 52-year-old tossing every spare dollar into a 401k or index fund. It's safe, but it's slow, and the gains are often locked away until retirement. Now picture a different approach. They channel their cash flow into a mix of dividend-paying stocks, high-yield REITs, and a small cash-flowing side hustle, like renting out a property or consulting. Suddenly, their money isn't just sitting. It's earning, reinvesting, and earning again. The cycle is alive, breathing, and building momentum. Late starters can't afford idle capital. You need a portfolio that's dynamic, not dormant. A system that multiplies with every step. The 3 pillars of smarter compounding. To make this practical, let's distill it into 3 foundational pillars that anyone starting late can apply. These aren't get-rich-quick schemes. They're grounded, powerful strategies that work when combined. Pillar 1. Accelerated cash flow. Your compounding engine needs fuel, and that means increasing what you can reinvest, not just annually, but monthly or quarterly. This isn't about cutting out your morning coffee. It's about leveraging your skills and time. Launch a side hustle, take on freelance gigs, or monetize an asset you already own, like renting out a spare room. Every extra $200 reinvested monthly outperforms a lump sum a decade later. Continuous cash flow is your lifeline when time is tight. Pillar 2. Liquidity with yield. Traditional retirement accounts are valuable, but they're rigid. Late starters need investments that deliver returns and access. Dividend-focused ETFs, covered call funds, or short-term real estate deals let you reinvest gains without penalties or delays. You're not just banking paper profits. You're putting real dollars back to work, creating a compounding loop that moves faster than a locked-up 401k. Pillar 3. Layered leverage. Leverage isn't about reckless borrowing. It's about using your resources, credit, partnerships, or even seller financing to amplify growth. For example, a small business loan to scale a side hustle or a mortgage for a rental property can collapse a 15-year plan into 7 if you manage the risks. The key is clarity. Know your downside, cap your exposure, and never bet the farm. Combine these pillars: stronger cash flow, liquid high-yield assets, and intelligent leverage, and you've built a compounding machine that runs on your timeline, not someone else's. If you're vibing with part 4 of our Compounding Comeback series and want part 5 ASAP, drop "comeback" in the comments to let me know you're in. Avoiding the panic traps. Here's where most late starters stumble. Panic sets in, and it pushes them toward one of 2 dead ends. The first is chasing high-risk bets, speculative stocks, volatile crypto, or options trades with no safety net. It feels like a bold move to catch up, but it's a gamble, not a strategy. One market dip can wipe out years of progress. The second trap is paralysis, deciding it's too late, so why bother? They hoard cash, avoid learning, and let regret call the shots. Both paths lead to the same place: nowhere. Wealthy late starters know better. Compounding isn't about perfection or 100% returns. It's about discipline, positioning, and staying in the game. You don't need to hit home runs. You need consistency, access, and adaptability. A plan tailored to your timeline, income, and reality is 10 times more powerful than chasing unicorns or giving up entirely. A strategy built for you. So, how do you play offense and defense as a late starter? Here's the blueprint. Stack intentionally. Cut the noise and focus on investments that compound reliably. Diversified index funds, ETFs with strong track records, or dividend stocks with reinvestment plans. Automate your contributions to make momentum unstoppable. No chasing trends, just assets with staying power. Protect the base. You can't afford reckless losses, so keep your emergency fund solid, tackle high-interest debt, and avoid market timing traps. Resist the urge to go big or go home. The wealthy win by playing smart, not swinging for the fences. Accelerate with purpose. Don't just save more, find ways to earn more. A side gig, a raise, or a tax-optimized strategy can boost your contributions dramatically. Even modest returns compound faster when you're fueling the machine with more. This isn't a flashy plan, but it's built for your reality, not the fantasy of a 20-something with decades to spare. It's about controlled leverage, not blind hope. The emotional reset. Let's get real. Starting late often comes with a heavy emotional load. Regret over missed opportunities, frustration over past mistakes, or fear that the window has closed. But regret isn't a strategy, and it's not who you are. It's just a feeling, and feelings pass when you act. The truth? You don't need to have started at 22 to build wealth. You need a decision today to stop comparing yourself to others and focus on what's possible. Your clock didn't stop, it just reset. Wealthy late starters know the best time to plant a tree wasn't 20 years ago. It's the moment you wake up to your potential. If this guide is your wake-up call, you're already on day one. Shift your mindset from "I'm behind" to "I'm aligned." Aligned with a strategy that fits your life, your values, and your goals. Progress isn't about luck, it's about focus. And you're not alone. Thousands in our Compounding Comeback series community have shared the same regrets and the same realization. The power lies in what you do next. Your next steps. In the final part of this series, we'll tie it all together with a clear, actionable step you can take today, even if you're starting with modest means. No theory, just results. For a head start, check out my referral link to public.com below. It's the investing platform I recommend for its flexibility and beginner-friendly tools. A quick note, this content is for educational purposes only and isn't investment advice. Always do your research and consult a financial professional before making decisions. Investments can fluctuate, and past performance doesn't guarantee future results. Assess your risk tolerance and goals before committing capital. If this guide sparked a new perspective, watch the next video in the series. Like, share, and subscribe to stay in the loop. Drop a comment below, especially if this made you rethink your approach. Your support fuels this journey. Until next time, stay focused, stay strategic, and keep building. You're not just a late starter. You're a money magician rewriting your story. See you in the next one.